Have you ever considered how Islamic banking, a system that forbids interest, actually manages to thrive in a global economy? This unique form of banking challenges conventional systems with its distinct characteristics. Central to these is the prohibition of interest, or riba, a concept that significantly shapes the management of Islamic banking. This fascinating world of finance operates on principles that may seem unconventional, but have proven to be remarkably effective. So stay tuned to understand the principles that guide this intriguing form of banking. To comprehend Islamic banking, one must grasp its fundamental principles. At its core, Islamic banking operates on a set of principles aimed at establishing fairness, transparency, and shared risk in financial transactions. Let's delve into these principles. First and foremost is the prohibition of riba, or interest. In traditional banking, interest is a key component of the lender-borrower relationship. However, in Islamic banking, charging or paying interest is strictly forbidden. This is rooted in the belief that money in itself holds no intrinsic value and thus should not generate profits on its own. Instead, profits should be derived from legitimate trade and investment in assets. Next is the concept of risk sharing. In Islamic banking, the risk of any financial transaction is shared between the parties involved. This means that both the bank and the customer share the risk of any potential loss. By doing this, Islamic banks promote financial stability and ensure that no one party bears the brunt of financial loss. Then, there's the prohibition of gharar, or uncertainty. Islamic banking forbids transactions that are ambiguous or uncertain. This principle ensures that all parties involved in a transaction have clear, comprehensive knowledge of the essential details. This way, the likelihood of deception or unfair practices is significantly reduced. Lastly, Islamic banking adheres to ethical standards that promote social welfare. This means that banks are prohibited from investing in businesses that are considered harmful to society or that go against Islamic values. This could include businesses involved in the production of alcohol, pork, or weapons, or those engaged in gambling. These principles, while challenging to implement, form the backbone of Islamic banking and its unique approach to finance. They steer the sector towards a more equitable and ethical way of doing business, aligning financial practices with moral values. It's not just about making money, it's about making a difference. And that, in essence, is what sets Islamic banking apart. These principles, while challenging to implement, form the backbone of Islamic banking and its unique approach to finance. Now, how do these principles translate into the day-to-day management of Islamic banks? Well, it's quite fascinating. The principles of Islamic banking aren't just theoretical, they're woven into the very fabric of these financial institutions. A key player in this process is the Sharia Advisory Board. Comprised of scholars well-versed in Islamic law, this board ensures that all banking practices are in line with Islamic principles. They're like the moral compass of the bank, guiding every decision and transaction. Yet guidance is not enough. The management of Islamic banks also incorporates these principles into their operational systems. One such method is the use of profit and loss sharing arrangements. Instead of traditional interest-based lending, banks and customers share both the risks and rewards of any financial venture. It's a partnership, a mutual journey into the world of finance. But what about the destination? Well, the journey is just as important. Islamic banks place a strong emphasis on ethical investments. They avoid industries that are prohibited under Islamic law, such as those involving alcohol, gambling, and pork. They also steer clear of speculative transactions, focusing instead on investments that contribute positively to society. So the management of Islamic banks is not just about making a profit, it's about honoring a set of religious principles, fostering fair and equitable relationships, and promoting ethical investment. It's clear that the management of Islamic banks requires a delicate balance between religious obligations and financial realities. Islamic banking, as we've seen, is a unique blend of faith and finance. It operates under a different set of principles than conventional banking. It's a system that integrates the teachings of Islam into the world of finance, creating a harmonious balance between economic growth and ethical responsibility. We've delved into the core principles of Islamic banking, including the prohibition of interest, the emphasis on risk sharing, and the commitment to ethical and socially responsible investments. These principles aren't just rules, they shape the entire management structure of Islamic banks. We've also explored how these principles influence the management of Islamic banks. From the top-level decision-making to the everyday operational activities, every aspect of an Islamic bank's management is guided by these principles. In a world dominated by interest-based financial systems, Islamic banking offers a distinct and ethical alternative. So, the next time you wonder about the workings of Islamic banking, remember this. It's not just about the money, it's about a whole new perspective on ethical finance.